You had $10,000 and two choices: Buffett or Dalio. 30 years later, one turned into $400,000, the other $150,000. But here's the irony. The strategy that wins on paper is the one that makes real investors crack under pressure. And I'm about to show you why, with one chart that changes everything. In the next 10 minutes, I'll show you real data Wall Street hopes you never see. I spent weeks diving deep into every crash and recovery since 1995. What I discovered shocked me. The highest return strategy? It's the one most investors emotionally can't survive. By the end, you'll know why Buffett's ride looks like a heart-pounding thriller, and Dalio's like a slow-burn detective drama. Before we dive into Buffett versus Dalio, understand this. What you're watching isn't just a breakdown of billionaire strategies. It's the kind of story they'll never put in a finance textbook. This is the Wealth Project. Subscribe and follow now to learn the rules the rich play by. The philosophies. Let's start with Buffett, the Oracle of Omaha. His strategy sounds too simple to work. Find wonderful companies with economic moats, businesses so dominant that competitors can't touch them. Buy them at a fair price and hold forever. No complex algorithms, no hedging, just conviction and patience. In 1988, right after the market crashed, Buffett invested over $1 billion into Coca-Cola when everyone else was terrified. He saw a globally dominant brand temporarily beaten down by fear. That single decision, by 2025, that stake grew to over $25 billion. This is the Buffett way. Be greedy when others are fearful. But here's the catch. Buffett's path requires an iron will. You have to watch your portfolio drop 30, 40, even 50% during crashes and not sell. Most people can't do that. They panic. They sell at the bottom. They destroy their own wealth. Now, Ray Dalio, the king of hedge funds. Dalio built Bridgewater into the world's largest hedge fund by doing the exact opposite. He doesn't believe in conviction. He believes in systems. His philosophy? You cannot predict the future, so diversify to protect yourself from your own ignorance. He studied economic history and discovered the world moves in predictable cycles, the economic machine. In 2008, when the financial system was collapsing and most hedge funds were bleeding billions, Dalio's flagship fund returned between 9 and 14%. While everyone else panicked, his system worked exactly as designed. For regular investors, he created the all-weather portfolio, a radically diversified mix designed to perform in any economic environment. 30% stocks, 40% long-term bonds, 15% intermediate bonds, 7.5% gold, 7.5% commodities. So now you understand the two philosophies. Buffett says, bet big on what you know. Dalio says, build a system that survives anything. But which strategy actually works better when you put real money on the line? What I'm about to show you is the most important chart you'll see all year. The $1 billion stress test. Let's run the numbers. You had $10,000 in 1995. Two choices. Invest it all in Berkshire Hathaway stock or split it across Dalio's all-weather portfolio. Then hold for 30 years through every crash, every panic. Here's what happened. By 2025, that $10,000 in Berkshire Hathaway grew to over $400,000, a 40 times return. Absolutely massive. The all-weather portfolio? Around $150,000, a 15 times return. Incredible, but nowhere near Buffett's number. But here's where the story gets interesting. The path to that $400,000 was absolutely brutal. During the 2008 financial crisis, Berkshire Hathaway dropped nearly 50%. If you had $100,000, you watched it become $50,000 in months. That's not just a number. That's your kid's college fund, your retirement, your future evaporating. The all-weather portfolio during the same crash? It dropped less than 4%. Barely a scratch. While Buffett investors were losing sleep, having panic attacks, and many were selling at the bottom, Dalio investors slept soundly. The chart tells the whole story. Berkshire's line is a jagged, terrifying mountain. The all-weather line is a smooth, steady hill. So Buffett's strategy made more money, a lot more, but Dalio's strategy protected you when it mattered most. That raises the most important question. What good is a strategy that makes more money if you can't actually stick with it? But here's the truth most people won't tell you, and this is where the real answer lives. When you see that jagged line of Berkshire's volatility next to Dalio's smooth curve, it forces a deeper question. What would you have done in 2008? Let me know in the comments. Would you have held on like Buffett or slept easy with Dalio? And if you're finding this breakdown valuable, a like lets us know to keep deconstructing a wealth this way. The human factor. The biggest destroyer of wealth isn't a bad strategy. It's human emotion. People panic sell at the bottom and FOMO buy at the top. They sabotage themselves. Buffett's advice for average people has always been simple. Buy and hold an S&P 500 index fund. Don't try to be fancy. Don't time the market. Just invest consistently and hold forever. The data backs him up. Since 1965, the S&P 500 has averaged over 10% annual returns. Consistent investment in an index fund over 30 to 40 years has mathematically made millions of Americans into millionaires. The beauty of Buffett's philosophy is its democratic simplicity. You don't need to be a genius, you just need patience and discipline. The legendary Berkshire millionaires of Omaha, regular people who bought the stock decades ago and held, are proof. Teachers, secretaries, small business owners who became wealthy simply by not selling. But here's the problem. That 2008 crash scared millions out of the market permanently. They watched their portfolios drop 37% and said never again. They sold at the bottom and never came back. The strategy works, but only if you can survive the psychological torture. Now Dalio's approach. The all-weather portfolio's superpower isn't its returns. It's its minimal drawdown. That tiny 4% drop in 2008 is everything. It's a system designed to prevent that catastrophic loss that leads to emotional mistakes. You don't panic sell if you're only down 4%. You stay in the game. Dalio's philosophy provides a higher floor, not a higher ceiling. More people finish the race because the strategy prevents them from crashing. We've seen the numbers, we've seen the psychology, but we still haven't answered the core question. Which approach has actually created more millionaires? The answer might surprise you because it's not just about the math. The verdict. Here's the truth. Buffett's philosophy has created more millionaires through sheer democratic simplicity. The S&P 500 index fund strategy he champions has made more regular people wealthy than any complex hedge fund system ever could. It's accessible, it's understandable, it's repeatable. You don't need to be sophisticated. You just need to start and not stop. But, and this is massive, Dalio's philosophy provides the blueprint for how the already successful stay millionaires. It's a system for protecting wealth from the cycles and emotional errors that destroy empires. Here's the deeper insight. Buffett's strategy has a higher potential ceiling but requires superhuman emotional control. Dalio's strategy has a more reliable path but lower ultimate returns. The question isn't which is better, it's which matches the investor's psychology and their stage of wealth. And here's something almost nobody talks about. Buffett himself is sitting on over $180 billion in cash right now. That's more than the GDP of Hungary. The Oracle is on the sidelines. What does he see that we don't? Is he waiting for the crash that Dalio's work predicts? Because Dalio's 2021 book, The Changing World Order, predicted exactly the kind of political division and global tension we're seeing in 2025. He designed the all-weather portfolio for this exact moment of uncertainty. So here's what you need to understand. Both strategies work, but they work for different people at different times. For the next generation with decades ahead, Buffett's way is the rocket ship, wild turbulence, but it'll take you the highest. For the empire builders guarding their treasure, Dalio's fortress is the safer bet. While others flee the fire, you're still standing. And here's the twist. The best strategy isn't the one with the highest returns on paper. It's the one the investor can actually survive through the terror, the doubt, and the chaos. Because a good strategy you stick with beats a perfect one you abandon. Buffett built a philosophy that creates millionaires through simplicity and conviction. Dalio built a system that protects millionaires through diversification and discipline. So the question isn't which billionaire is right, it's which path you'd walk without breaking. Because the perfect plan is worthless if you can't survive the storm. But here's the thing, this video is just the beginning. There are billionaire secrets no one's telling you, psychological tricks and systems that quietly build generational wealth. This journey was just one chapter in the larger story of wealth. The next billion-dollar play is one click away. Keep playing smarter with The Wealth Project. Pick our latest insight or a curated favorite right here on your screen.